Okay, let's kick off. I'm sure there are still a few people logging on, but they'll just miss my intro, so that's not the end of the world. So good morning. Thank you for joining us to hear analysis from our experts on a budget that held a few surprises, actually. My name is Esther Carter. I'm a media partner in our West End office of Kingston Smith. I'm sure most of you are quite familiar with who we are. There are quite a few familiar names on the delegate list. We get a few regulars to these webinars, but for those of you who don't know us so well, Kingston Smith is a top 10 audit, tax and advisory firm in the UK. We work with businesses across all different industries, as well as private clients and not-for-profit, and we're also part of More Global, which is an international network with presence in over 100 countries. And in the West End office, we've got 7 partners and around 100 staff specialising exclusively in working with media clients. And by media clients, we mean the whole range, so marketing services, film, TV, theatre, anything really that falls in that media pot. So last week we heard from the Chancellor that a technical recession would be avoided. Excellent. Inflation is coming under control. Brilliant. And the energy prices are also falling. So far, so good. But he resisted calls to reverse the increase in the headline rate of corporation tax, unfortunately, and did nothing to address the fiscal drag of the personal tax thresholds being frozen. As ever, the devil is always in the detail, so I'm delighted to be joined by our tax partners, Nick Blundell and Claire Roberts. Nick is a specialist in all things relating to corporate and business tax, and Claire is one of our private client experts. So please do ask questions as Nick and Claire go through their presentations. This webinar is for you. So in as far as we can answer your specific questions, we would love to do that. Please pop them in the Q&A function. It's much easier for me to keep track of them there. And then I will try and weave those questions into Nick and Claire's presentations. If we don't get around to answering any of your specific questions, then we can follow those up with you later on. This session is being recorded, so please do share with any of your peers or anybody who couldn't make it today. And after the session is over, we will be giving you a little feedback form. Please do fill it out. It's super useful in helping us to shape future webinars. So without further ado, I will hand over to Nick and Claire.
Thank you, Esther. Good morning, everyone. So I'm going to cover off the personal tax announcements that we heard in the budget, as well as some of the announcements that we did hear previously, but will be coming in from the 6th of April. So it'll be a useful reminder of what to bear in mind as we go into the next tax year. So the 2 big announcements, insofar as personal tax was concerned, related to the pensions regime. So changes were widely expected, but I think the extent to which the changes came quite a surprise to many. So the surprise announcement was that the lifetime allowance will be abolished. So the changes take effect from the 6th of April 2023, when the charge will be removed, and then it will be completely abolished from the 6th of April 2024. Broadly, the effect is the same. It's just that I think that they can't rush the legislation through in time in terms of the complete abolition. So we've got that 2-stage process over the next 2 years. So the current lifetime allowance is £1,073,100, and it is the maximum amount that you can save into a pension pot without triggering income tax charges on the excess. Once that lifetime allowance is breached, excess benefits are taxed at 55% to the extent that you take those benefits as a lump sum, and 25% if the benefits are taken as a pension. Now, the rationale behind this move, as you may have heard a lot in the press over the last few days, is to encourage the over 50s back to work, particularly senior NHS doctors, where it's believed, rightly or wrongly, that the main driver for them leaving the workforce or reducing their hours is the pension regime. So naturally, there are mixed views on whether this will achieve the desired outcome or whether it will allow people to simply save more and retire early. But nevertheless, good news for anyone who is nearing or has breached that 1 million threshold. As always, the devil is in the detail, and this change does come with a big caveat that for most people now, the maximum tax-free lump sum that they'll be able to take is limited to 25% of the current lifetime allowance. So that's a value of £268,275. However, if you do have a lifetime allowance protection currently in place, such that you have a right to take a higher lump sum, you will be able to continue to do so. And any amounts taken in excess of that amount will be taxed now at your marginal rate of income tax, to 45%, rather than the 55% flat rate as is currently the case. Now, there will be people that have different forms of protection, fixed protection, individual protection, which were introduced years ago, well, in recent years, to protect the value of your pension pot from excess tax charges and retain the lifetime allowance at a higher historical rate. Now, typically where you have protection in place, you're not usually able to make further contributions to the scheme without losing the protection. Now, there were some concerns that individuals with that protection who would now be looking to make further contributions following a change in these rules would then risk invalidating that protection and therefore limit themselves to this 25% limit of £268,275 lump sum. However, post-budget, HMRC did release some guidance, and it did confirm that if you do have valid protection in place, you will be able to make further contributions to your scheme post 6th of April 2023 without losing protection, and will continue to have the right to that higher 25% lump sum. So hugely generous really in being able to retain that protection for what could be, in some cases, very sizable pension pots. Now, the other change that we saw in relation to pensions was the annual allowance. So this was expected, it was trailed a couple of days in advance, and that annual allowance will be increasing from £40,000 to £60,000 per tax year from the 6th of April 2023. So that's the maximum amount of tax relief pension savings that can be made in a tax year, with any excess savings being taxed at your marginal rate of tax. Now, as is the case at the moment, where you have unused allowances from the previous 3 tax years, you will be able to continue to carry forward those amounts and add those to your current year allowance. Now, it doesn't stop there. If you are a higher earner, the amount of your annual allowance is tapered. As it stands at the moment, where your income is over £240,000, the amount of the annual allowance is reduced by £1 for every £2 of excess income over £240,000 down to a minimum of £4,000. But both those thresholds and that amount are going up from the 6th of April 2023. So the income level at which the tapered annual allowance kicks in will be increased to £260,000, and the minimum tapered annual allowance will be increased to £10,000. It's probably easier to demonstrate what I mean by looking at this table. So this will show, well, it effectively shows the current position where your earnings are over £240,000. That is where the annual allowance begins to taper away. So you can see that for every £10,000 of earnings, increase in earnings, then your allowance will reduce by £5,000 down to £4,000 when you hit £312,000 of earnings. Now, from the 6th of April 2023, you can see that if you're earning £325,000, you're able to actually put in £34,000 post 6th of April 2023. So a big increase there if your earnings are around that limit. And the new bracket now that we're concerned with is the £260,000 to £360,000. So you can see that post 6th of April, that allowance will begin to taper away from £60,000. And then once your earnings hit £360,000, you'll be limited to making contributions of £10,000 per tax year. So one question that we've seen from a few clients over the last few days So higher earners may have stopped making pension contributions due to being close to the lifetime allowance, or they may have already breached it. So now they've asked, well, can I use that carry forward that I've got from the previous 3 years? And the answer is yes. So depending on what your income was in those years, you potentially have £40,000 to carry forward from the previous 3 tax years, plus the 23-24 allowance of £60,000. So to the extent that it's possible, you could actually save 180,000 into your pension in 23-24, tax-free without any tax charges. Obviously, that's the extent that you're able to, and if the employer was able to make the contribution, then that would be a tax-free benefit in the employee's hands, provided that the overall package for that employee is reasonable based on the duties that they would perform. So quite generous in terms of what you were able to do there. Now, Labour did come out quite quickly following the announcement and say that if they win the election, the next general election, then they will reverse these changes. So possibly a short window of opportunity in terms of being able to contribute now if you have breached the lifetime allowance. And if Labour do get in, then we'd be back to people having protections in place like we have done when the allowance has been reduced in previous years. So possibly a year or so to make the most of these changes. And the key message here is, if you are looking to make further contributions, particularly post April 2023, and you have protection in place, please do seek advice from your financial advisor or one of our financial advisors to make sure that you don't fall foul of any of the rules, because we don't yet have the complete picture in terms of the legislation and how the rules will operate. So that's it on pensions. So I thought it would be useful just to recap on the income tax rates and thresholds that will apply from the 6th of April 2023. So we already knew that the income tax personal allowance and higher rate threshold are frozen at their current values of 12,570 and 50,270 until April 2028. Those same thresholds apply to the lower earnings limit and upper earnings limit for national insurance contributions. And this is where we're going to see, the income tax squeeze over the next few years as more and more people are brought into paying higher rates of tax as inflation pushes wages up. One change that we will see from the 6th of April 2023 is the reduction in the additional rate threshold. Excuse me. So that will be reducing from £150,000 to £125,140. And if you recall, that number is the oddly specific number just is because that's the limit at which the income tax personal allowance is completely withdrawn. So it will mean if you're in that threshold, in that bracket rather, of between 125, 140 and 150,000, you will be paying an extra 5% on your earnings. And you will also lose your eligibility for the £500 personal savings allowance, which is the tax-free allowance for savings income. So if you do earn interest on a bank account, then you will now have to pay tax on that savings income.
Claire, somebody's asked, well, obviously you've got the basic rates of income tax there, and then you've got the other rates of tax next to it. Could you just explain what that second column of tax rates are? So the 8.75.
Oh, sorry. So yes, the 2014-45 are the main rates of income tax that apply to earnings, non-savings income, and the 8.75, 33.75 and 39.35 are the rates applying to dividends. So if you are going to be within that 125, 140 bracket to 150, there is still a window of opportunity to plan for the 6th of April. So you could consider accelerating any income to pre-5th of April to the extent that you're able to, and that will ensure that more income is taxed at a lower rate in the current tax year, rather than 45% in the next tax year. And we didn't see any changes to the rates that I've just explained. Now, dividend allowance. So currently there is an allowance of £2,000 within which you can earn dividends tax-free. That will be reduced to £1,000 from the 6th of April 2023 and halved again to £500 from April 2024. So inevitably, this is going to mean more people will need to file tax returns to report that dividend income and pay the tax. Particularly the likes of pensioners who supplement their income with dividends. So just something to be aware of and to keep an eye on that if you are going to be breaching those thresholds. Dividends received in an ISA are tax exempt, so you could consider perhaps selling the shares in your personal name, buying them back in an ISA. Therefore, the income will be tax-free within the ISA going forward. Excuse me. So capital gains tax, as always, lots of speculation before the budget about whether the rates would change, but thankfully no change there to the rates. So the main rates remain as they are, 10 and 20%, depending on whether or not you're a basic rate taxpayer or higher and additional rate taxpayer. And the rates applying to residential property are 18% and 28%. But one change we will see from the 6th of April 2023 is a reduction in the capital gains tax annual exemption. So currently that's 12,300, but it's effectively being halved to £6,000 for the next tax year and halved again to £3,000 in the following tax year. So again, to the extent that you're able to, you could consider accelerating any disposals into the current tax year, crystallise those capital gains now and maximise exemptions at that current exemption rate. And if you can utilise that whole exemption in the current tax year, then that would represent a tax saving of up to £1,764 compared to next tax year.
There was a comment on the previous slide, actually two slides back now, about business assets disposal relief.
Oh, yes.
Just to explain a little bit more about that.
Yeah, so business asset disposal relief, what was previously known as entrepreneurs relief, applies to qualifying business disposals, and where you do qualify for relief, the gain is taxed at 10% rather than the higher rates of 20%. No changes there to the rules from next tax year.
And that's still at the million, isn't it? That it was
still million. Yeah, the lifetime allowance is still at million. So no change there. So one measure that had already been announced at I think it was last year sometime, and has been confirmed in the spring budget are the rules relating to capital gains tax on separating and divorcing couples. So currently, where spouses or civil partners separate, transfer of assets between them are treated as taking place, but no gain, no loss. But this only applies to disposals in the tax year that they separate. And after that, transfers are treated as normal disposals at market value for capital gains tax purposes. Now, the spring budget did confirm that from the 6th of April 2023, the no gain, no loss principle for the transfer of assets between separating spouses and civil partners will be extended for up to 3 years after the tax year that they stop living together. And it will also apply to the transfer of assets undertaken as part of a formal divorce agreement. In addition, a spouse or civil partner that's retained an interest in their former home will also have the option to claim principal private residence relief when they come to sell the property. And if a spouse or civil partner has transferred their interest in the home to their ex, and they're entitled to receive part of those proceeds when the home is eventually sold, they'll be able to apply the same tax treatment to those proceeds that would have been available at the time of the original transfer. So all in all, much needed modernisation to these rules, which will no doubt be a welcome to separating couples. So inheritance tax, another area that's been ripe for reform for many years, but no real major changes here. We knew that the thresholds are fixed until 2028, so we've got the nil rate band 325,000 and the residence nil rate band of 175,000, and the limit at which that residence nil rate band tapers away will continue to be 2 million. But one change that we did see in Wednesday's budget was a restriction to the scope of agricultural property relief and woodlands relief for inheritance tax, both of which allow you to pass qualifying assets to the next generation tax-free, and that relief will now be restricted to property only in the UK, whereas before you could claim the relief for property located in the EEA, Channel Islands and Isle of Man. So perhaps quite limited in its application, but worth mentioning. And similarly, I'll go back one. In a similar vein, charities, various charitable tax reliefs will also be restricted to UK charities and community amateur sports club from the 15th of March 2023, so effective from budget day. With the exception being that EU and EEA charities that already qualify for tax reliefs will have a transitional period up until April 2024. So again, probably likely to have limited impact, but clearly both these measures seemingly following a trend that the government is trying to concentrate its resources and favourable tax treatment on entities with a UK presence. And I'll now hand over to Nick to cover the corporation tax, business tax updates.
Thanks, Claire. And just before we move on, Esther, was there anything else from the personal tax elements of questions?
No more questions. Hopefully you'll get a few more, Nick. Come on, everybody. Ask Nick some really.
No, that definitely wasn't an encouragement. Yeah, thanks. As Esther said at the beginning, my name is Nick Blundell. I'm a corporate tax partner here at MKS, and I'm pleased to be going through the budget changes in respect of corporate taxes. So we'll talk about rates and capital allowances and R&D and creative sector reliefs, because those are the main things that were announced last week. So I'm hoping that we've managed to work this, that I can move it, but I can't. Claire, I'm wondering if you may need to do this, move the slides for me.
Okay.
Thanks. Yeah, so corporate tax rate, that has or will move from the 1st of April, so just less than 2 weeks away now, from 19% to 25%. It had been 19% since 2017, actually, and the increase to 25% is the highest rate we've seen in the UK for over 10 years now. It seems strange with all this sort of political ups and downs that we've had. Will they, won't they increase the corporate tax rate from 19 to 25? That actually this increase to 25 from the 1st of April 2023 was announced and legislated for 2 years ago, and the legislation has not changed despite the political announcements and comings and goings in Downing Street and at the Treasury. So we are increasing to 25%, and with that sees the reintroduction of a sort of 2-tier corporate tax system. We've had for quite some number of years now a flat rate of 19%, but now, although the headline rate is increasing to 25%, we are reintroducing a lower rate, which is the old 19% for profits of up to £50,000. In effect, the first £50,000 of profits are paid at 19%, and the profits over £250,000 are paid at 25%. And if you have profits in between the 50 and the 250,000, you'll actually pay at the marginal rate of 26.5%. It's a bit like Claire talked about earlier, where you lose your personal allowance over 100,000 and you pay it at a very high rate on that slab of income. Similarly, for that slab of income between 50 and 250, you actually pay at a marginal rate of 26.5% until you get to 250,000. So yes, so moving on into some context though of where the rate is sitting. The government had of the day had been for many years saying it wanted the most competitive tax regime globally, certainly amongst the G20, and that's what it had done in terms of bringing its rate down to 19%, and its rate had stuck below everyone else in the G20. That's been ditched now. You can see, even though at 25%, it is lower than many countries in Europe. But if you move to the next page, we can see that it's moved higher than a lot of countries as well. I've highlighted the United States because in reality the US rate is higher than that, because that's the federal rate of 21%. There will always be state taxes which effectively take the rate, which we don't have, which effectively takes the rate above 25%. Ireland is another one I've highlighted in sort of post St. Patrick's Day green for you, but that's that's quite a significant difference between us and Ireland, where our rate compared to the Republic of Ireland is now double. So the only other, I suppose, sort of the only English-speaking country in the EU, and Ireland has done a lot to sort of try and encourage investment from outside of Europe into Ireland itself. The Chancellor has been really keen, as he's increased the rate to 25%, to say that there's a lot of context around that, and you've still got to consider the ease of doing business in the UK, the incentives that we have here, the workforce, the size of our market, and so on. And I guess sort of saying while we're still more attractive than lots of other countries do business, regardless of the rate. And the first point I put there, which is the relief on capital expenditure, and there were some quite big announcements about that, which we'll move on to now. So capital allowances. Capital allowances are the tax deduction you get for your capital expenditure, your fixtures and fittings, your tables, your laptops, and so on that you've got. For the past couple of years, we've had a super deduction. A lot of you will be familiar with that, where since 1st of April 2021, for a 2-year period, any expenditure that you've had on fixed assets, you've been able to claim a 130% deduction in the first year. So you spend £100 on something and you take a tax deduction for £130 straight away. That was always designed to be temporary. That's come to an end, or it comes to an end in a week or so's time, and it's effectively been replaced with two things. One, the annual investment allowance that was already announced and has been around for some years now, but it was already announced that it will be permanently set at £1 million from 1st of April 2023. So for the vast majority of businesses, and indeed the Chancellor announced himself that this will cover 99% of businesses, for the vast majority of businesses that never spend more than £1 million a year on their capital expenditure, they'll be able to get immediate tax relief on an ongoing basis straight away in the year of expenditure. So that covers most businesses. So unless you're a very capital intensive business or have got a very big one-off cost each year, you'll generally be able to rely on the annual investment allowance. And that applies to all businesses, companies, sole traders, partnerships, and so on. The announcement that was made last week that is I guess primarily for those that are much more capital intensive, I guess more big business, is the full expensing allowance, and that is temporary from the 1st of April to 2023 for 3 years to the 31st of March 2026. And let's take a look a bit more about what that looks like. So the important thing to note for the full expensing is it is only for companies. So if you are a sole trader or if you are a partnership, There's obviously lots of partnerships of law firms, accountancy firms, architects businesses, so on. These do not benefit from that. They do benefit from the annual investment allowance that I mentioned, but they don't benefit from the full expensing. So if you've got a big office fit out that's going to cost more than £1 million, you won't be able to rely on full expensing. Now, what that says is, so full expensing, you get 100% first year allowance on all of your the vast majority of your capital expenditure, but it does need to be new and unused items, which is what the super deduction was based on. It was encourage investment in new fixed assets. So it does need to be new and unused in order to qualify for the 100% first year allowance. There's also a 50% allowance for items that qualify for the special rate pool, which are more sort of integral features in a building in the main, things like electrical wiring, lift shafts and so on, and other type long life assets, like printing presses and things like that, things that are expected to last a long time. So you get a slightly slower rate of capital allowances there. But really what that's saying, what the full expensing is saying, is that pretty much every business that spends money on capital expenditure is going to get an immediate tax deduction for everything that they spend, rather than how it was in the past, which is can be quite a slow rate of capital allowances and tax deduction. So this is really to provide relief to the to big business, really, for the increase in corporate tax rate from 19 to 25%. I mean, if you look at the numbers in the Treasury's numbers, this full expensing, even though it only applies to 1% of businesses, some of those 1% of businesses are spending significant amounts each year on capital expenditure, and will be able to take as a result, we'll be able to take significant deductions straight away, which will give them relief against their increase in corporate tax rates. There's also there's obviously some anti-avoidance, so you can't go and spend a load of money and then scrap it, and then having taken the benefit of a big expense deduction, you'll have an adjustment back if you do that. So there's obviously, as you'd expect, various anti-avoidance, and I did just want to labour the point that that it is only companies that can benefit from the full expensing. So if you are a partnership, or if you're a sole trader and spending more than £1 million a year, so not able to take on the excess over the million that you don't get the annual allowance for, you'll get a much slower rate on that excess over £1 million. So for the main rate pool, which is the majority of capital expenditure, 18% on a reducing balance basis, which takes a long time to get relief for the capital expenditure. So it's worth being aware of that. So that is capital allowances. We'll move on now to changes to the R&D scheme. A lot of which, sort of in terms of the big announcements, has already been made, and there's a lot of stuff going on in terms of the government's thinking on the R&D scheme at the moment. So there are some sort of headline changes from the 1st of April 2023 that were announced in the autumn. If you are a large company, and that primarily, without going into the detail of the limits, is businesses where, as a group, as part of a worldwide group, you've got employees over 500. You'll be in that scheme. Is that so that's becoming more generous. The credit is increasing from 13% to 20%, and the way that scheme works is it's kind of like a cash grant. So if you spend £100 on R&D, you'll get £20 back, but that £20 is taxable. So at 25% under the new rate, so you effectively get a 15% credit. The SME scheme, conversely, is becoming less generous. The way in which the SME scheme works is not for the moment changing, but the percentages are reducing, which means that the benefits, which I've highlighted on the next page, will reduce. So, for example, if you, I mean, the starkest change is for SMEs that are spending money on R&D and are making losses, and the losses that they surrender for the R&D credit is reducing quite significantly. You can see there the 33.35% down to 18.6%. So almost halving in terms of the benefit. Now, there's a couple of reasons why this is being done. One is the government generally feels that lots of SMEs and particularly lots of R&D advisors are being overly aggressive on claims and not within the spirit of the rules, and there's fraud and so on. So instead of trying to tackle some of those specific areas, what they've basically said is we're going to reduce the benefit of the scheme overall. So coupled with that, they're also trying to move towards a single scheme, which I'll talk a bit more about a bit later. What they have said is we realise that the benefit for loss-making SMEs is reducing quite significantly. So in recognition of that, what they are saying is if you're a very R&D intensive business, and what they mean by that is spending over 40% of your total expenditure on R&D, then you'll get a better rate. So we won't reduce you from 33.35% that I had on the previous slide all the way down to 18.6%. We'll up it back up a bit to 27%. So you will still get a reduction from where you were, but if you're R&D intensive, your effective credit will be 27% for every pound you spend, rather than the reduced 18.6%.
Nick, somebody's asked if you still have claims to make for previous years, will they be treated at the new rates or under the old scheme? And is there a new deadline to get those prior year claims in?
So prior years are still as they were. So prior years, so I don't know, let's say the 31st of December 2021, that would still be under all the old rules. These are the sort of going forward rules that aren't even in place yet. They'll come in with effect from April. So if you've got a historic year, those will still be under the old rules and are still subject to the same time limits. So let's say December 2021, you've got 2 years to make that claim, and that needs to be in by the 31st of December 2021 under all the old rules. So there's nothing that they're changing retrospectively. These are all prospective changes.
And it's probably worth saying that we do have a R&D specific webinar that we did fairly recently on some of the new rules that were coming in, that is recorded and available on our website. I can't remember whether you were speaking at that, Nick, or
another one I think I spoke on, but not that specific one that you're referring to.
So I mean it is worth watching that, and we do focus a little bit in on media companies and what sort of expenses might classify as R&D for media businesses.
Yeah. This slide is just designed to illustrate how the large company scheme, which is the RDEC column, and the SME scheme are sort of converging in terms of their overall benefit. And although they operate in a different way, the numbers are becoming closer quite deliberately, I think. Overseas expenditure. Now, this was quite a big announcement in the autumn, where so historically, if you've a UK business but you've got R&D personnel overseas, then you would have been able to claim for their R&D costs within your UK R&D claim. That's to all intents and purposes, is being stopped, and it was going to be stopped from the 1st of April 2023. That's been delayed by a year, which is good news for those who've still got people overseas and have made and for whom that's been a big part of their claim. So I suspect that's some lobbying to allow businesses to sort of get things in order if they want to bring people back on shore, back to the UK and so on, and change around the way in which their R&D is done. there's some, I mean, this was announced a while ago as well, that some additional elements are being added to the guidance of what qualifies. So data licenses and cloud computing services will also be available for R&D. This is quite useful to be aware of. This is part of the trying to deal with some of the fraud and the aggressive claims that I talked about earlier. If you're new to making R&D claims, and what I mean by that is if you haven't made an R&D claim in the last 3 years, you will need to, going forward from the 1st of April 2023, submit a notification to the revenue within 6 months of your year end to say that you are planning to make an R&D claim. So I mentioned earlier that there's a 2-year time limit for putting R&D claims in, and what that had meant was that there was lots of people very validly putting in very historic claims, let's say from, I don't know, you theoretically the year ended June 2021 is still open. But going forward, if you haven't made previous claims, you're going to need to notify the revenue within 6 months of the year end to say that you are planning to make a claim, and then you actually make the claim within the normal time limits. But if you don't do that claim notification, you won't be able to make an R&D claim when it comes to it. Also, for all claims made from the 1st of August, so this is sort of irrelevant to the period that we're talking about. This is the actual date of submission of the claim. For all claims made from the 1st of August 2023, R&D claims will need to be submitted with what they're calling an additional information form. So it's, if you like, it's a means of sort of standardizing some of the R&D claim, and so you're going to have to put various specific information which goes on to the revenue. So it's a bit like, I suppose, with the tax return, which is a very formalized document ultimately that goes in. You'll need to do that for your R&D claim as well. So it'll need to contain some specific information. So that's that. Consultation on a single scheme. So it's very much the revenue's intention that they will basically do away with the SME scheme. The way that works, it's got full of, they are right in what they've said, that it's full of complications, and the credit can work in lots of different ways depending on if you're making profits or losses, what your overall tax profile is, and they want to get rid of that, move to one simple scheme. The RDEC scheme that's used for larger companies is much simpler to understand. It's much more of a level playing field, and it basically just says, if you spend money on R&D, we will give you a 20% effectively cash grant on that, and that will be taxable. Regardless of whether you've got tax losses, you're paying tax, your tax profile of your company, if you've got losses brought forward, that all gets taken away, and it just becomes a single, much more understandable scheme. Now, their intention is that will be from the 1st of April next year. I think that I wouldn't be surprised if that gets pushed back, because there's quite a lot to think about in the detail, and they're still making changes that we've just been talking through. So that's R&D, and then just to finish with on audio visual reliefs. So the way in which various creative sector tax reliefs have worked historically, film, animation, high-end TV, children's TV, video games credits, have all worked kind of like in the R&D SME scheme, which is that you know, if you've got a tax loss as a result of taking a tax deduction under any of these reliefs, you then essentially sell that loss to the revenue for a 25% credit. That is going, and they are, having been through consultation in the autumn that they issued the response to a couple of days ago, they are planning to introduce a R&D large company type credit where for your expenditure you will effectively receive a cash grant, which again itself is taxable. And I've just shown those rates on the next page. And so if you are if you're making claims under animation or children's TV, you'll get a 39% credit, but once that gets taxed, it'll be 29.25 pence in the pound. And for film, high-end TV and video games, it will be a 34% credit, so 25.5 pence in the pound. So and just back on that slightly, Claire, both of those are more generous in the government side than the existing scheme, because if you, in the existing scheme, you essentially sell the losses for a 25% credit, and both of those come out, both of the new, but all the new schemes come out effectively at a net of more than that.
Nick, somebody's asked, what does high-end TV mean? Because many media companies are making lots of video content. I suspect that sort of video content doesn't classify as high-end TV. Does it? I imagine TV is more the longer form TV rather than short pieces of content.
I understand it's more the longer form of content. I think there was a 30-minute qualification, which is being reduced to 20 minutes, but it does have that qualification criteria on it. I mean, in the main, this is a change to the way in which the relief system works in terms of how relief is given. Primarily, what types of things qualify is not changing, but there is that change in terms of they are making the length of a high-end TV program slightly shorter, but from 30 to 20 minutes. So yeah, this is just to say that there's essentially a transitionary period. So the new credit, which will replace the tax relief, will come in for accounting periods ending from the 1st of January 2024 onwards, and then there'll be a transitionary period through to March 2027 to deal with sort of claims that are made and will continue to be made under the existing system as that gets phased out and the new one gets phased in. Theatre, orchestra, museums, exhibitions and galleries. So the relief that is there, that is on a tax relief system under the sort of R&D SME style of scheme, where you might create a loss and sell that loss to the revenue. So as people who work in this in any of these industries will know, the government increased the credits for a temporary period post COVID, and those dates on there are on there, where it increased from 27th of October 2021 and then phases back down to the old levels from 2024. Now, if you just move to the next slide, Claire, you'll see basically the exact same set of, oh, gone one too far. Oh, one more. No, we're going the wrong way, I think. There we are. Same set of numbers, but the government has increased the temporary additional relief, extended, I should say, for another 2 years. So those higher credit rates will go through till March 2025, before then phasing back down towards the old rates. The museums, exhibitions and galleries relief is being fully phased out, but that's being fully phased out such that there'll be no relief anymore. But that is being delayed by 2 years as well. There's a couple of Brexit changes. I mean, these reliefs have some references to the EU in there and the EEA. So as part of the government dealing with all the legislation that it's got that's got references to the EU in it, there will be some tweaks to the what qualifies for what type of expenditure qualifies for these reliefs. But we're still waiting for more detail on that. And I suppose just to say, we put this in the slides, but given that the R&D scheme is moving to the sort of cash grant type system, and given they want to they're moving the audio-visual reliefs to a cash grant type system, I wouldn't be surprised if they announce the same for theatre and orchestra in the long term, when those higher reliefs are phased back down to the standard rates. I would have thought that they'll move that system to a cash grant type system as well. And that's everything from me. I think Claire was going to return at the end to the tricky question of should you pay yourself a salary or a dividend, which has gone through some changes in the last couple of weeks based on the specifics. But I think that's it from me, unless there's anything else.
No outstanding questions. Thank you, Nick.
Thank you, Nick. Just quickly to end with, I thought it'd be useful to look at the effective rates of tax for business owners on profit extraction, given that we have now got the increase in the corporation tax rates and dividend rates have increased in recent years. So it previously used to be the case that paying yourself a small salary and topping the rest of your income up with dividends.
Claire, your voice is coming in and out, but you might want to move your mouthpiece, but it's not catching.
There we go. Start again. So it used to be the case that paying yourself a small salary and topping the rest of your income up with dividends was the most tax efficient strategy for taking profits out of a company. But with the increase in tax rates, that's not necessarily the case anymore, and it may now be worth reassessing whether you are still taking cash out of the business in the most tax efficient way. So unless you are a company with profits of less than 50,000 and paying corporation tax of 19%, you can see from this table that the cheapest way to take money out of the company is by way of salary, which might come as a surprise to many. So the thing with salary, as you will all know, is that you do pay the tax on that in real time when salary is paid, whereas there is a bit more flexibility with dividends in terms of delaying the payment of tax depending on when you take the payment. But I thought this would just be quite useful to show. As you can see that in most scenarios, the least tax efficient approach now is to operate through a company and extract the profits by way of dividends. That's it from me.
It's going to take a bit of digesting that, isn't it? I think it's really going to be quite individual, case by case, depending on whether you're at the, the flat 25 or you're caught in that horrible marginal tax rate between 50 and the 250. And what's happening to your personal tax rate. So I would urge everyone to review their current dividend v remuneration strategies, obviously bringing benefits in kind and pension strategies into that thinking as well, and just get those reviewed just to make sure that there's not any unnecessary tax erosion there. Because some of the differences and those percentages are quite large. Sorry, Nick.
I think we have pulled together a model to help people with that. To plug numbers in to spew out what we hope is the right answer.
Yeah, exactly.
People need help for that.
Super. Well, we don't have any outstanding questions in the Q&A. Obviously, if you do have any follow-up questions, please email them in and we will answer them for you. But other than that, it looks like we've all gained about 6 minutes back into our diaries, which I'm sure you'll all be grateful for. So thank you all very much for joining us. Don't forget it was recorded, so please do share it, and hopefully you'll be sent a feedback form shortly when you close down. Please do fill that in. Like I said, it's super useful. So thank you very much, Nick and Claire, for running us through all of those budget changes, and enjoy the rest of your day, everybody. Thank you very much.
Thanks. Bye.
Bye-bye.